Disclaimer.
On Christmas Day 2025, while most Americans opened presents with their families, something unprecedented happened in China's commodity markets. Physical silver vanished, completely disappeared from trading desks in Shanghai and Shenzhen. Prices spiked to record local levels as traders desperately searched for metal that simply wasn't there. And here's what should grab our attention. The futures contracts flipped into backwardation, a technical term that means one thing. People who need silver right now are willing to pay more than the future price because they cannot wait. Think about what that actually means. You're telling me the spot price exceeds the futures price? That's not supposed to happen with industrial commodities. It's like saying people would rather pay premium prices for a car today than wait 3 months and pay less. The only time that makes sense is when you're convinced the car won't be available in 3 months. But wait, it gets more interesting. And just one day later, on December 26th, silver hit an all-time high of $79.39 per ounce in New York trading. That's a 169% gain year to date. Let me put that in perspective for you. If you owned silver at the start of 2025, your investment nearly tripled while the S&P 500 delivered around 25%. So naturally, you'd think this would be headline news everywhere, right? Oh, Wall Street celebrating. Financial media doing special reports, your financial advisor calling to discuss precious metals allocation. Except that's not happening. The silence is deafening. And whenever something this significant occurs with this little mainstream attention, we need to ask ourselves what we're not being told. Here's what I discovered digging through Federal Reserve meeting minutes and commodity exchange reports. 2 weeks before Christmas, between December 9th and 10th, the Fed cut interest rates to a range of 3.75% to 4.0%. Now you might be thinking, so what? The Fed adjusts rates all the time. But here's the thing. Rate cuts inject liquidity into the financial system. They make dollars more abundant, which historically drives investors toward hard assets that can't be printed into existence. But that's only half the story. At the exact same moment the Fed opened the monetary floodgates, President Trump deployed 15,000 troops and 11 warships to enforce a complete oil blockade against Venezuela. We're talking about cutting off 600,000 barrels per day, much of it headed to China. This wasn't some symbolic gesture. This was a geopolitical earthquake that sent shockwaves through commodity markets worldwide. Pop quiz: what happens when you simultaneously expand global liquidity and create major geopolitical uncertainty? If you answered massive flight to safe haven assets, you're getting warmer. But the real story is what has been happening behind the scenes for the past 5 years that made this particular moment so explosive. According to the Silver Institute's 2025 World Silver Survey, we've experienced 5 consecutive years of structural deficits in the silver market. Not cyclical shortages that resolve themselves, structural deficits that cannot be fixed by normal market mechanisms. The cumulative deficit totals 800 million ounces. To put that number in context, that's equivalent to 1 full year of total global silver production, just gone. Consumed, converted to industrial applications, locked away in products that will never return that silver to the market. Have you noticed? Your solar panels don't come with a silver recycling program. That's because the silver is permanently embedded in photovoltaic cells. Same with the circuit boards in your smartphone, the 5G infrastructure being built across our country, the electric vehicles replacing combustion engines. Industrial applications are consuming silver faster than miners can dig it out of the ground. And unlike gold sitting in vaults that could theoretically come back to market, the silver is functionally destroyed. Now here's where the math gets uncomfortable for the banks. COMEX registered stocks. That's the physical silver available for immediate delivery backing futures contracts in New York, have been drained by 70% since 2020. The London Metal Exchange inventories sit at historic lows. We're watching a mathematical impossibility unfold in real time. There are more paper claims on silver than physical metal available to deliver. Think about this scenario for a moment. You hold a futures contract promising you 5,000 ounces of silver, deliverable on demand. You decide to take physical delivery instead of rolling the contract forward. You submit your delivery notice following all the proper procedures, and then you're told, well, we can't actually deliver your silver right now, maybe next month. Maybe we can give you cash instead at today's price. This isn't theoretical speculation. Industry insiders who watch the delivery notices at COMEX have observed delays, excuses, and an increasing preference to settle contracts in cash rather than metal. When a commodity exchange designed to facilitate physical delivery starts avoiding physical delivery, that's not a market functioning properly. That's a market breaking down. Let me connect these dots for you in a way that affects your daily life. The Trump-Venezuela blockade is not just about oil. It's about forcing China to compete for energy resources in a tighter market. When China faces energy constraints, their industrial machine slows down. But they're not reducing silver consumption. If anything, they're accelerating it because their solar build-out and electric vehicle transition are national priorities tied to energy independence. So what does China do when they need more silver but global production is flat? They buy it on the spot market. And what did we just see happen on Christmas Day? China's markets ran out of spot silver and went into backwardation. The immediate supply vanished precisely when demand was supposed to slow down for the holidays. According to data from the Shanghai Gold Exchange, Chinese silver premiums, the amount above global prices that Chinese buyers are willing to pay for immediate delivery, spiked to double-digit percentages over Christmas. That's not normal market behavior. That's panic inventory building by industrial users who cannot afford production shutdowns because they can't source silver. Meanwhile, back in New York, our COMEX vaults theoretically have silver available. But here's the disturbing part revealed in the Bank for International Settlements quarterly commodity review. The velocity of silver movement through COMEX has slowed dramatically. Metal comes in, metal goes out. That's how commodity exchanges work. Except now metal comes in and stays there. It's not moving. Refiners are operating at capacity trying to meet fabrication demand, yet physical silver sits in New York vaults while Shanghai pays premiums. You know what that sounds like to me? A broken delivery mechanism, a just-in-time system that's no longer delivering on time. The paper market in New York and the physical market in Asia are experiencing a divorce, and when that happens, the paper price stops reflecting actual acquisition costs. We've seen this movie before with other commodities. We watched it happen with nickel in 2022 when the London Metal Exchange had to halt trading because short sellers couldn't deliver metal. We saw it with palladium markets when auto catalyst demand outpaced Russian supply. But silver is different because it's simultaneously a monetary metal, an industrial metal, and increasingly scarce relative to gold. And that brings us to the emergency meeting that's not being reported in mainstream financial media. Industry sources indicate major stakeholders in the silver market: miners, refiners, large industrial users, and yes, representatives from bullion banks have been in accelerated discussions about supply chain integrity. Not public hearings, not regulatory announcements, just quiet meetings about a growing crisis that could disrupt industries employing millions of Americans. What are they discussing behind closed doors? How to manage a market where 5 years of deficits have created a situation where paper markets cannot guarantee physical delivery. How to prevent a panic when industrial users who need silver for manufacturing realize they are competing with investment demand in a market that's structurally short. How to maintain price discovery when the traditional mechanisms are breaking down. The $85 price target being whispered in these meetings isn't arbitrary speculation. It is the mathematical point where the pain becomes unbearable for short positions that cannot deliver where industrial users are forced into long-term supply contracts at any price where the paper market either finds equilibrium with physical reality or breaks completely. Let me show you the receipts, because what I am about to reveal is not speculation or conspiracy theory. It's raw data from industry reports that fundamentally changed how I understand what is happening in our economy right now. The Silver Institute's latest industrial demand data shows something that should be front-page news, but somehow isn't. In 2025, industrial applications consumed over 700 million ounces of silver. That's not total demand, that's just the industrial side. To put this in terms you can visualize, imagine every solar panel installation across America, Europe, and China. Now imagine the circuit boards in every smartphone sold globally this year. Add the silver paste in every electric vehicle battery system, the 5G infrastructure build-out happening in our cities, and the explosion in AI data centers that require massive amounts of electrical switching components. According to the World Bank's renewable energy tracking data, solar photovoltaic installations alone consumed approximately 30% of that industrial demand. But here's what makes this different from other commodity cycles. When you install a solar panel on your roof, that silver is gone forever from the market. You're not going to dismantle your $20,000 solar array in 5 years to extract $50 worth of silver. The economics don't work. That metal is effectively destroyed, converted from a tradable commodity into a functional component of energy infrastructure. Now think about electric vehicles for a moment. A traditional combustion engine car might use half an ounce of silver in various electrical components. Have you looked under the hood of a Tesla or checked out the battery management systems in modern EVs? Each vehicle requires somewhere between 5 to 10 times more silver than traditional cars because of the sophisticated power electronics, the charging systems, and the battery management controllers. We're talking about 5 ounces per vehicle minimum, and luxury EVs can contain up to 25 ounces. What happens when the International Energy Agency's 2025 transportation report shows global EV sales hit 18 million units this year, up from 14 million in 2024? You do the math. That's 90 to 180 million additional ounces of silver permanently removed from circulation. And this transition is just beginning. Most analysts project 40 million EVs annually by 2030, which means the automotive sector alone could consume 200 to 400 million ounces per year within 5 years. But wait, there's a critical piece of this puzzle that the mining industry doesn't want to talk about openly. Total global mine production in 2025 came in at approximately 813 million ounces, according to the Silver Institute's preliminary estimates. Notice something? Industrial demand of 700 million ounces against mine supply of 813 million ounces creates a deficit of, well, actually, it doesn't create a deficit yet when you just look at those two numbers. Here's what they're not telling you in the headline figures. Total silver demand, industrial plus investment plus jewelry and silverware, exceeded 930 million ounces in 2025. That creates an annual deficit of 117 million ounces. That has to come from somewhere. Where does it come from? Existing above-ground stockpiles, scrap recycling, and previously accumulated inventories. Except we've been running deficits for 5 consecutive years, which means we've been steadily draining those stockpiles. Now here's the part that should terrify anyone with paper silver exposure. Unlike other commodities, where higher prices immediately incentivize more production, roughly 75 to 80% of silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. What does that mean in practical terms? It means silver miners can't just produce more silver when prices spike because they're not primarily silver miners. Think about this scenario. Silver hits $100 per ounce tomorrow. Sounds great for silver mining companies, right? Except the major producers like Fresnillo, Pan American Silver, or Kerr Mining are actually producing copper or zinc, and silver comes along for the ride. They're not going to dramatically increase their extraction operations just for silver if copper prices don't justify the expansion. The geology determines the mining, not silver prices alone. According to S&P Global Market Intelligence data on mining operations, it takes 7 to 10 years to bring a new major mine from discovery to production. You can't just flip a switch and produce more silver next month. This creates a permanent structural deficit that cannot be solved by normal supply responses to higher prices. The market is mathematically broken at the supply level. But let me show you where this really gets interesting. The physical silver market started decoupling from paper markets in a way that's never happened before. Silver-backed ETF outflows in Q4 2025 totaled 187 million ounces, according to Bloomberg commodity tracking data. Now, normally, when ETFs experience outflows, that's bearish. It means investors are selling, right? Except that's not what happened this time. Those outflows went directly to physical delivery. Investment firms and wealthy individuals who previously were happy holding SLV shares started demanding physical bars delivered to private vaults. They were converting paper promises into metal they could touch, and that created a cascade effect through the supply chain. Premiums on physical silver coins from the US Mint, Canadian Maple Leafs, and private mint products hit double-digit percentages over spot price. I'm talking about scenarios where silver is trading at $79 per ounce in New York, but if you want to actually buy American Silver Eagles, you're paying $88 to $92 per coin, including premiums. That's a 15% premium just to get physical metal in your hands. What does that tell us? The paper price of $79 no longer reflects actual acquisition costs for physical silver. According to the CPM Group's Precious Metals Yearbook, refiners reached maximum capacity trying to convert 1,000-ounce commercial bars into smaller retail products. The bottleneck isn't mining, it's the physical infrastructure to process and deliver metal to end users. Here's a scenario that perfectly illustrates the broken market dynamics. COMEX vaults in New York are reportedly overflowing with silver, tons of it sitting in registered and eligible categories. Meanwhile, in Shanghai, buyers are paying premium prices and experiencing shortages. Why doesn't silver flow from New York to Shanghai to capture that arbitrage profit? The answer reveals the dysfunction: logistics delays, refining bottlenecks, export controls being whispered about, and most importantly, Western banks reluctant to drain COMEX inventories because those inventories are the only thing maintaining confidence in paper contracts. If COMEX stocks drop below critical thresholds, the exchange might have to restrict deliveries or face a squeeze that makes the nickel crisis of 2022 look like a minor hiccup. Now, let me connect this to something happening in a completely different market that's creating a mathematical floor under silver prices. Central bank gold purchases in 2025 surged 73% according to the World Gold Council's quarterly reports. We're talking about Poland, China, India, Turkey, and other nations buying gold at rates not seen since the 1970s. Why does this matter for silver? Because of the gold-silver ratio, one of the oldest relationships in commodity markets. This ratio currently sits at approximately 57:1, meaning 1 ounce of gold buys 57 ounces of silver. But here's the fascinating part. The ratio hit a peak of 107.1 during the March 2020 market panic. What happens when central banks aggressively buy gold, pushing gold prices higher? The gold-silver ratio compresses as silver plays catch-up. Algorithmic trading systems watch the gold-silver ratio constantly. If it stretches too far beyond historical norms, algorithms automatically sell gold and buy silver to capture the mean reversion. This means banks cannot simply smash silver prices anymore without simultaneously destroying gold markets. They definitely cannot afford to undermine gold when central banks are the primary buyers. Think about the political implications for a moment. If the Federal Reserve or allied Western central banks tried to suppress gold prices while Poland, China, and India are buying, that creates a massive diplomatic incident. Those countries would view it as financial warfare, an attempt to devalue their reserve assets. So gold has political protection now, and that protection extends mathematically to silver through the ratio. According to Renaissance macro research analysis of commodity correlations, this creates what they call a doom loop for precious metal shorts. Any intervention to lower prices triggers physical buying from industrial users who need the metal, investment buying from ratio traders, and central bank buying protecting gold. The traditional tools for managing a precious metals prices, futures dumping, lease rate manipulation, coordinated selling, no longer work when physical demand overwhelms paper market mechanisms. Let me paint you a picture of what's actually happening on trading desks right now. Commodity fund managers who went short silver betting on industrial demand collapse are watching losses mount daily. These are not small positions. We're talking about institutional funds with hundreds of millions in short exposure accumulated when silver was trading at $45 to $50 per ounce earlier in the year. They're trapped. Covering those short positions requires buying physical metal or futures contracts, which pushes prices higher, which increases their losses, which triggers margin calls. Some funds are rumored to be negotiating with clearinghouses for extended settlement terms, trying to avoid forced liquidation. But there's a limit to how long exchanges will tolerate settlement failures before they change the rules. The London Bullion Market Association's recent clearing statistics show record volumes, but declining available inventory for immediate delivery. Translation? Lots of trading, not much actual metal changing hands. That works fine in normal markets where most participants are happy with cash settlement. But when a critical mass of market participants demand physical delivery simultaneously, the system breaks. We're watching the just-in-time delivery model that worked for decades hit a permanent wall. Industrial users built their supply chains, assuming silver would always be available at some price with short lead times. Solar manufacturers, electronics companies, automotive suppliers, they're all discovering that assumption no longer holds. The lead times for physical delivery have extended from weeks to months for large quantities. What do sophisticated industrial users do when they realize supply chains are breaking? They engage in panic inventory building, buying 2 years ahead instead of 3 months ahead. That accelerates the physical removal from markets. According to industry surveys from the Silver Users Association, major consumers have shifted procurement strategies from just-in-time to just-in-case, fundamentally changing demand patterns in ways that exacerbate shortages. Now, let me show you the specific price targets that technical analysts and commodity traders are watching, because these aren't random numbers. They are mathematical levels derived from decades of market behavior patterns that have proven remarkably accurate in precious metals. Silver broke through the critical $50 resistance level back in May 2025, a level that had capped prices since the 2011 spike. But once that barrier fell, technical analysts immediately started calculating Fibonacci extension levels, a mathematical tool based on the golden ratio that appears throughout nature and has shown uncanny accuracy in predicting commodity price movements. The first major Fibonacci extension from that 50 breakout sits at 85 per ounce, the 1.272 extension level. What's significant about this number isn't mysticism, it's market psychology. Enough traders watch these levels that they become self-fulfilling as buy and sell orders cluster around them. We're currently at $79, which means we're within 8% of a level where massive option positions expire, where stop-loss orders from short sellers cluster, where industrial buyers have standing orders to secure supply. But $85 isn't the final destination according to this technical framework. The 1.618 Fibonacci extension, the golden ratio itself, projects to $96 per ounce. And then there's the psychological fortress of $100, a round number that carries enormous weight in commodities trading. Triple-digit silver isn't just a price level, it's a paradigm shift that forces every financial institution to recalculate their precious metals allocation models. Here's what you need to understand about how these targets connect to the physical market reality we've been discussing. We're in year 5 of an 800 million ounce cumulative deficit. That's not counting 2025's additional 117 million ounce shortfall. The math is straightforward and brutal. Every year we consume more silver than we mine, and that has to come from existing stockpiles. According to the Silver Institute's analysis of above-ground stocks, visible inventories have declined from approximately 2.5 billion ounces in 2020 to under 1.8 billion ounces today. But here's the critical detail. Most of that above-ground stock isn't available for sale. It's in jewelry, silverware, religious artifacts, industrial applications, and private holdings that won't come to market unless prices reach levels that make melting and recycling economically attractive. For context, you're not going to melt down your grandmother's silver tea set unless silver hits prices that make the metal value substantially exceed the sentimental value. Industry studies suggest only about 20% of above-ground silver could realistically return to markets even at triple-digit prices. That means the available stockpile is closer to 360 million ounces, less than half a year's deficit. What happens when you systematically drain finite stockpiles for 5 consecutive years? You reach a mathematical inflection point where the market structure breaks. We're not talking about a gradual adjustment. We're talking about a systematic liquidation event where the remaining sellers recognize scarcity value and demand massive premiums, while buyers panic because they cannot secure supply at any reasonable price. Now, layer in the Venezuela situation, because this is not just about oil. It's about forcing a fundamental recalculation of commodity markets in the context of great power competition. You might think 4% doesn't sound like much, but in commodity markets, that marginal 4% determines whether prices are stable or volatile. China cannot simply replace that Venezuelan heavy crude overnight. The refinery configurations, the shipping logistics, the payment systems are all optimized for specific supply chains. Disrupting that creates immediate pressure on China's entire energy complex. What does China do when facing energy constraints and geopolitical pressure simultaneously? They double down on strategic resource accumulation. According to customs data, Chinese commodity imports surged in December across the board: copper, aluminum, rare earths, and yes, precious metals. They're building strategic reserves as insurance against supply disruptions, and that buying pressure hits markets already stretched thin by industrial demand. But here's where the situation gets truly concerning for anyone betting against precious metals. The Federal Reserve's response to potential commodity market stress involves activating currency swap lines with European and Japanese central banks. These swap lines, detailed in the Fed's weekly balance sheet releases, essentially flood dollars into foreign banking systems to help them cover commodity-related losses and maintain liquidity. Think about what that means in practice. European and Japanese banks have exposure to commodity trades, many of which are going badly as prices surge. The Fed provides dollar liquidity to prevent a cascade of margin calls and defaults. But that liquidity doesn't disappear. It flows into the broader financial system, expanding the money supply. More dollars chasing the same amount of hard assets means higher prices for gold, silver, and other commodities that can't be printed into existence. This creates what analysts call a doom loop for central banks. Every attempt to rescue the financial system from commodity. Volatility requires monetary expansion, which drives commodity prices higher, which requires more rescue operations. The Fed is trapped between allowing a deflationary crash that would devastate leveraged institutions or continuing monetary expansion that accelerates the precious metals rally. According to Bank of America's commodity strategist team, this dynamic ensures that any significant dip in silver prices gets bought aggressively by multiple players: industrial users securing supply, algorithmic traders playing the gold-silver ratio, and momentum investors following technical breakouts. The traditional downside protection for short sellers has evaporated. Now let me tell you about a specific timing window that has market insiders extremely focused. Monday, December 30th, when Asian markets open for the first trading day after this Christmas holiday week. Why does this particular Monday matter? Several factors converge simultaneously. First, miners have been strategically withholding production at current prices. Major silver producers are sitting on inventory waiting for higher prices rather than selling into a rising market at $79 when they can wait for $100. This is rational behavior. Why sell today when you know demand exceeds supply and prices are climbing? Second, Mexico represents approximately 25% of global silver production, making them the world's largest producer. Political developments in Mexico around mining regulation and resource nationalism have created uncertainty about export availability. Industry sources indicate discussions about potential export restrictions or nationalization of strategic resources, particularly as Mexico seeks to build its own solar and EV industries that require silver. What happens if Mexico decides to restrict silver exports to ensure domestic industrial supply? A quarter of global production potentially locked away from international markets would create immediate crisis conditions for industrial users in other countries who are already struggling to secure metal. Third, And this is where things get really interesting. There are persistent rumors circulating through London commodity trading circles about a shadow banking fund with massive short positions in silver and long positions in bonds, both trades that have failed catastrophically in 2025. Bonds sold off as inflation concerns mounted, and silver rallied relentlessly. This creates a nightmare scenario, losses on both sides of what was supposed to be a hedged position. If these rumors have substance, we could see forced liquidation that triggers a buying cascade with no resistance levels above current all-time highs. Market participants call this blue sky territory. When an asset breaks above its previous all-time high, there's no historical reference point for where it might stop. No chart patterns, no previous resistance levels, nothing but supply and demand in real time. Technical analysts point to the 2011 silver rally that went from $30 to nearly $50 in a matter of weeks once momentum built. But this time, the industrial backdrop is completely different. In 2011, silver was primarily an investment play. In 2025, we have structural deficits driven by technologies that cannot function without silver, solar panels that governments are mandating, electric vehicles that automakers are committed to producing, 5G and AI infrastructure that our economy depends on. The Federal Reserve data shows that their balance sheet expansion in late December, ostensibly to provide year-end liquidity, adds fuel to this fire. Every dollar the Fed creates to smooth financial system functioning is another dollar that can chase hard assets. The monetary backdrop supports triple-digit silver even as the physical market fundamentals demand it. Here's what this means for everyday Americans trying to understand these markets. If you own silver, whether physical coins, ETFs, or mining stocks, you're holding an asset approaching a systematic repricing. If you're planning to buy silver, the window of opportunity at current levels may be measured in days, not weeks or months. For those working in industries dependent on silver, particularly solar installation, electronics manufacturing, or automotive suppliers, supply chain managers need to understand that price volatility ahead could be severe. Locking in long-term supply contracts, even at premium prices, may prove cheaper than spot market purchases 6 months from now. For investors with balanced portfolios, the precious metals allocation that seemed excessive when silver was $25 might look prudent when it's testing $100. The traditional 5 or 10% precious metals allocation recommendations from financial advisors were built for markets where supply and demand function normally. We're entering a period where normal rules may not apply. The mathematical reality is inescapable. 5 years of 800 million ounce deficits cannot continue indefinitely without forcing a price adjustment that brings supply and demand back into balance. Either prices rise high enough to destroy marginal industrial demand, or they rise high enough to incentivize massive recycling and new mine development that takes years to come online, or they rise high enough to make substitution economically viable in applications where silver can be replaced. But here's what the emergency meetings are really about: the recognition that none of those adjustments happen quickly or smoothly. Industrial users cannot simply stop making solar panels or electric vehicles because silver gets expensive. Recycling infrastructure doesn't exist at scale for many applications. New mines take a decade to develop. Substitution research is years away from commercial viability. This creates a gap period where prices must rise to ration available supply among competing uses. That's not fear-mongering, that's basic economics. And the market appears to be pricing in exactly that scenario with a move toward $85, then $96, then $100 in the coming months. The Venezuelan blockade, the Fed's liquidity expansion, the industrial demand surge, the central bank gold buying, the paper market dysfunction, the Chinese physical shortages, these aren't separate stories. They're all pieces of a puzzle that reveals a commodity market approaching a systematic repricing event. What separates this moment from previous silver rallies is the permanence of the demand drivers. Solar panels will keep requiring silver for decades as the energy transition accelerates. Electric vehicles will keep consuming more silver as combustion engines are phased out. 5G and AI infrastructure will keep demanding silver for advanced electronics. These aren't speculative bubbles that pop. They're structural shifts in how our economy functions. For Americans navigating this landscape, awareness is the first step toward making informed decisions. Understanding that the price you see quoted for silver may not reflect actual acquisition costs. Recognizing that paper claims on silver might not be convertible to physical metal when you need it. Realizing that industrial supply chains depending on silver face unprecedented challenges. The window we're discussing, Monday's Asian market open, represents a moment when holiday trading volumes return, when January positioning begins, when year-end financial statements are finalized. Market participants who have been waiting for clarity or hoping for better prices may decide this is the moment to act, and that collective action could accelerate the moves we've been discussing. This isn't about predicting the future with certainty. Markets can be irrational, interventions can delay inevitable adjustments, unexpected events can change trajectories. But The underlying mathematics of cumulative deficits, the physics of finite stockpiles, and the economics of surging industrial demand create a framework where much higher silver prices appear not just possible, but probable. Our role as informed Americans is to understand these dynamics, prepare accordingly, and make decisions that protect our interests while recognizing the broader implications for industries and supply chains our economy depends on. The emergency meeting may be hidden from public view, but the evidence of a market approaching critical inflection points is visible to anyone willing to look at the data objectively.